Bitcoin has officially broken below $100,000, marking its lowest level in 4 months. And this drop isn't just another dip in the chart. It's the kind of move that signals something deeper is happening under the surface. At one point this week, Bitcoin traded as low as $96,700, its weakest level since June. And that's coming off a high of over $126,000 just a few weeks ago in early October. That's a 20 to 25% slide in under a month. For a smaller cap crypto, that might be normal volatility, but for Bitcoin, especially post-ETF era, that's a serious correction. The first clear warning sign is institutional outflows. Spot Bitcoin ETFs, which had been fueling Bitcoin's rally throughout the summer, have now seen more than $1.3 billion in withdrawals since October 29. When that kind of capital starts exiting, it doesn't just slow the rally, it reverses it. ETF investors tend to move in big chunks, and their selling pressure ripples through exchanges fast. It's what analysts call order book vacuuming, sudden exits that remove liquidity and magnify price swings. So what we're seeing now is institutional players quietly backing away, while retail traders are left to deal with the volatility that follows.
When prices fall, leveraged traders, especially those using margin, start getting liquidated. Data from derivatives trackers shows that hundreds of millions of dollars in Bitcoin long positions have been wiped out in just a few days. These liquidations act like a chain reaction. One trader's liquidation pushes the price lower, which triggers more margin calls, which triggers more forced selling. It's the classic snowball effect that often turns a healthy correction into a sharp cascade. And that's exactly what analysts are saying, that what we're watching isn't panic selling, it's systemic leverage unwinding that could take weeks to stabilize. Now, step back and look at the global picture. The US dollar has strengthened again, interest rates are still high, and global markets have turned risk off. When that happens, Bitcoin usually struggles. It still behaves like a risk asset. It moves with tech stocks and growth trades, not against them. So what we're seeing now is Bitcoin losing its momentum, not just because of crypto-specific reasons, but because of macro headwinds. A stronger dollar, cautious investors, and tightening liquidity all mean fewer inflows into high-risk assets. And since Bitcoin had just come off one of its strongest quarters in years, the pullback feels even heavier. To really understand this drop, we've got to look back at October. The crypto market experienced a massive unwinding that month, one of the largest liquidation events of the year. Over $19 billion in leveraged positions across multiple exchanges were wiped out in a matter of days. That crash reset the market's risk appetite. For a few weeks afterward, Bitcoin bounced back, hitting those record highs above 126K. But beneath the surface, leverage was already thinning out. Traders who survived the October crash were trading smaller, more cautiously, and with tighter margins. So when November opened with weak ETF flows and a stronger dollar, it didn't take much to tip the balance again. Right now, analysts are split between two narratives. One camp says this is just a mid-cycle correction. They point out that long-term holders, or whales, often use these dips to accumulate. We've already seen large on-chain transactions from cold wallets, a sign that some big players are buying the fear. But the other camp, and this one's getting louder, warns that we could be looking at a deeper retracement if Bitcoin can't reclaim key levels soon. They're watching 100K closely. If it fails to hold or recover above 116K, it opens the door to targets around 85 to 90K, maybe even 75K in a worst-case scenario. And that's not fear-mongering. That's just technical structure. After a major rally, Bitcoin tends to correct deeply before stabilizing again. And the data right now, ETF outflows, high leverage, shrinking liquidity, all points toward a longer cooling-off period. So what does all this mean if you're in the market? If you're a trader, this is the time for tight risk management. Volatility is high and setups are unreliable. It's not the kind of environment where you want to chase short-term rebounds. If you're a long-term holder, perspective matters. Bitcoin has gone through drops like this before. It's part of the cycle.
The key is understanding where we are in that cycle. This correction could eventually set up the next leg higher, but only if broader macro conditions improve. If you're a new investor, this is a reminder. Bitcoin isn't immune to macro stress. It still reacts to global liquidity, interest rates, and investor sentiment. The myth of digital gold being completely decoupled from markets hasn't held up, not yet. Right now, there are a few technical levels that matter most. 100K, the psychological and structural support level. Lose it decisively and sentiment turns bearish fast. 90K to 95K, the next major support zone from June's consolidation. 116K is the resistance level that needs to be reclaimed to restore confidence.
As long as Bitcoin trades below that zone, expect volatility, uncertainty, and sideways pressure. Bitcoin dropping below 100K is more than just a headline. It's a stress test for how much conviction the market really has. We've been through hype cycles, ETF approvals, and record highs, but this phase feels different. This time, institutions are cautious, retail traders are exhausted, and macro pressure is back in the mix. It doesn't mean Bitcoin's story is over, far from it, but it does mean the market's next move will be shaped not by emotion, but by endurance. How patient can investors be when the easy gains are gone?